In 2005, Michael Burry sat in his office in California and told his investors he was shorting the housing market. They threatened to pull their money. His partners tried to remove him from his own fund. His own clients sued him. 2 years of everyone on Wall Street, every analyst, every commentator, every person with a credential and a platform, telling him he was wrong. Then 2008 happened and he made $700 million. I am telling you that story because I need you to understand who just published a warning about a potential 77% crash in the S&P 500. Not an anonymous blogger, not a podcast host with an agenda. The man with the single most documented track record of being right when the entire financial establishment was wrong. I subscribed to his Substack. I read every word of the post, and I am going to walk you through the whole thing right now. Because this is not a number he invented. It is a mathematical output of 125 years of actual market data. And once you see how he gets there, you are not going to be able to look at your 401k the same way again. But before we get to Burry's framework, I need you to think about a number. And this is a number that your financial planner, your broker, and every Dave Ramsey disciple on YouTube will never voluntarily bring up. It comes from looking at the S&P 500 all the way back to 1930. Not the nominal version, not the glossy version that goes up and to the right and makes you feel great about your index fund. The inflation-adjusted version. The one that measures actual purchasing power, what your money is actually worth in real terms after inflation takes its cut. And when you look at it that way, the market starts in 1930 at a reasonable level and then collapses, falling all the way into the mid-1950s before it even stabilizes. Now I want you to sit with this first number. If you had bought the S&P 500 at the 1930 peak and held it for 25 years, a full quarter century of buy and hold patience, you would not be flat. You would not have a small loss. You would be down close to 50% in real terms. 25 years, minus 50%. Stay the course, right? But it is worse than that. If you had bought in 1930 and just held on, done exactly what you were supposed to do, never panicked, never sold, you would have been essentially flat all the way until 1985. 55 years to get back to where you started in real purchasing power terms. And I already know what the buy and hold crowd is going to say. You could have sold at the peak somewhere in the middle. Sure. Except you are a buy and hold investor. That is the whole philosophy. You do not sell at peaks. Stay the course, right? And we are still not done. The person who looked at the market in the late 1960s and got in would have had to hold through everything until 1990, maybe the mid-1990s, just to break even in real terms, 25 to 30 years, just to see zero gain. Stay the course, right? And then the era that everyone points to as proof that buy and hold works, from 2000 to 2010, the inflation-adjusted S&P 500 went down and stayed down for a full decade. 10 years. Gone. How many of you watching right now have 30 years of runway? How many have 40 or 50 years, where you can park money in an index fund and be absolutely certain you will not retire directly into one of these multi-decade holes? Because the entire buy and hold argument assumes you do. It assumes you can absorb a 25-year drawdown and come out fine. For most working Americans with a real retirement timeline, that assumption is a financial death sentence. This is why Burry's warning matters. This is the reality behind the numbers they never put in front of you. Now, I want you to understand the actual machinery behind all of this. Because once you get this, everything else clicks into place. When the average working person thinks about what makes a stock go up or down, the answer they give is earnings. The company makes more money, the stock goes up. The company loses money, the stock goes down. The price reflects the performance of the business. That model is not completely wrong. It is just fatally incomplete, because the real equation has 3 pieces: price, earnings, and the multiple. The price-to-earnings ratio. The multiple can move the price of your stock dramatically in either direction, while the earnings sit completely still. The multiple can make you rich or wipe you out, independent of whether the company you own grew, shrank, or did nothing at all. That is the entire engine behind what Burry is warning about. Now, let me walk you through what Burry actually published. I pay for his Substack, and I am not going to cover every data point in the post, because that would not be fair to him or to the other paying subscribers. If you are not subscribed yet, The depth of analysis he puts out every couple of weeks is genuinely unlike what you will find anywhere else. But here is the core of the framework, because the framework is what matters. He went back to 1900, 125 years of market data. He focused on the Dow rather than the S&P 500, but do not let that trip you up. The math is identical. Same principle, different index, and he compared several versions of the same market across time. The raw nominal price, the inflation-adjusted price, and then the version almost nobody ever looks at. What would the market have done if you stripped out all the multiple expansion over those 125 years? Took the long-run average price-to-earnings ratio going back to 1900, held it constant, and asked, what did the underlying inflation-adjusted earnings actually do on their own? And the answer is almost nothing. From roughly 1920 all the way to the mid-1990s, the real earnings growth is nearly flat. The gigantic mountain you see on the nominal market chart, the one your financial planner uses to sell you on index investing, the vast majority of that movement has nothing to do with earnings growth. It is the multiple expanding, investors over decades bidding up what they were willing to pay per dollar of earnings. That is the whole show. Burry also ran the same exercise using just the average PE from 1990 to 2026, a more modern baseline. Same result. Strip the multiple out, and the inflation-adjusted earnings picture is nowhere near as impressive as the headline numbers suggest. And then he highlighted the specific periods where this worked in reverse. The secular bear markets. The long grinding stretches of real wealth destruction where the multiple compressed instead of expanded. And the numbers attached to those periods are not subtle. From 1906 to 1921, the market fell 65% in real terms. From 1929 to 1949, it fell 74%. And this one hits closer to home. From 2000 to 2013, it fell nearly 40% and took 13 years to recover. These are not blips. These are not dips that bounce back in a year. These are generational wealth destruction events. And Burry is not just throwing up scary red zones. He goes through 3 specific case studies to show exactly what drove each one. The first one, the secular bear market from 1966 to 1982. Every single dollar of those losses was driven by PE compression. The multiple contracted. And here's the brutal part. Earnings actually grew during that period. The businesses were doing better. Did not matter. The multiple compressed anyway, and investors lost in real terms for 16 years straight. Second case, the lost decade from 2000 to 2009. PE compression was responsible for a 98% drag on returns during that stretch, while earnings grew by positive 46%. Earnings were up 46%, and investors still got crushed because the multiple fell off a cliff. Third case, the 1982 to 2000 bull market. Multiple expansion drove most of it. Earnings helped in the early years, but by the late 1990s it was almost entirely a multiple expansion story. And from all of this, Burry draws a conclusion. It is stated plainly. Multiple compression is the primary mechanism of bear markets. In bull markets, multiple expansion shares the driver's seat with earnings growth. That is the whole game. So, stop watching CNBC earnings coverage with the same weight you have been giving it. The question that determines what happens to your 401k in the next 5 years is not whether corporate America posts good earnings. The question is what the current multiple is, where it stands relative to history, and what happens to your net worth when it normalizes. Burry answers that with a specific table. If the S&P 500 PE reverts to just the average from 1990 to 2026, the modern baseline, the S&P 500 lands at approximately 4,700, a decline of 32% from current levels. If the multiple reverts to the full historical average from 1927 through 2026, which Burry puts at a PE of 19.39, the S&P 500 drops 52%, more than half of everything in your account, gone. But he does not stop there. He goes to the actual trough multiples at the very bottom of those secular bear markets. Using the post-1980 trough multiple of around 11, the S&P 500 drawdown comes out to approximately 70%. And if you use the full historical record going back to 1921, the trough PE was around 9.25. At 9.25, the S&P 500 is down 77% from where it is today. 77%. Let that land for a second. This is not a number Burry invented. He took 125 years of actual market data, looked at what the multiple did at the very bottom of historical bear cycles, and asked, if we get there again, what does that mean for current prices? 77% is the answer, not the base case, the far end of the historically documented range, but a range that has been reached before, multiple times, and the people who got hit by it were also told to stay the course. Now, we have to talk about what actually triggers this, because a multiple compression thesis needs a catalyst. What flips the switch? And here is where Burry's argument connects directly to something that analyst Mike Green has been making the case for in great detail for years. The catalyst is passive investing, and once you understand how the plumbing works, you cannot look at an index fund the same way again. Picture a water tank. One pipe fills it from the top. One pipe drains it from the bottom. As long as the inflow pipe is bigger than the drain, the tank fills up. That tank is the S&P 500. Here is who the pipes are. On one end, you have the working-age Americans. They are in the labor market, they are earning a paycheck, and every 2 weeks HR takes 10% and drops it into a passive S&P 500 index fund. They are not picking stocks. They are not valuing businesses. They are just pumping money into the index automatically, regardless of whether the PE is 15 or 35 or 45. Say that inflow is $3 going in. On the other end, you have the retired crowd. They are drawing down their savings every month. They have to. That is the whole point of saving. Say they are taking $1 out. Net result, $2 of buying pressure. What does constant buying pressure do to prices? It drives them up. The multiple expands, not because earnings grew, because there is more money chasing the same shares. That is the machine that has been running for 40 years. Now flip that picture entirely. What happens when the demographic balance shifts? We know what is happening. The baby boomers have been leaving the workforce in large numbers. The wave of people moving from the contribution side to the withdrawal side is building, and the cohort entering the labor force behind them is smaller. So now instead of $3 going in and $1 coming out, what if we have $1 going in and $3 coming out? You already know where this goes. The buying pressure evaporates, the inflows reverse, and the multiple does not expand anymore. It compresses, the tank drains, and the S&P 500 reprices toward whatever the underlying inflation-adjusted earnings actually justify, which, as Burry's own analysis makes clear, is dramatically lower than today's prices. And demographics are not the only door this can come through. The labor market gets you to the exact same place. I had a long conversation with Mike Green about this, sat down with him for a couple of hours, and I asked him directly, in his models, at what unemployment rate does the passive investing machine flip from net inflows to net outflows? What is the tipping point? He said somewhere around 5.5 to 6%. Folks, that is not a Great Depression scenario. That is a run-of-the-mill recession, a completely ordinary economic downturn that happens on a regular cyclical basis. We do not need a catastrophe to trigger this. We need a normal recession. And here is a specific data point I want you to pay attention to. The most recent non-farm payroll print came in at negative 92,000, not a typo. Negative. The labor market is already showing you the early pages of this story. AI adoption, trade disruption, economic slowing. You can debate which one is doing the most damage. The result is the same. Fewer workers, fewer contributions, less money flowing into the passive machine. And the drain on the other end keeps running. It does not need a black swan. The mechanism is already built into the demographics and the employment trend. And it is patient. It does not care about your timeline or your retirement date. So, the question I know you have right now is, what do I actually do with this? I want to be crystal clear. This is not investment advice. Talk to a professional. But the single most instructive data point available right now is what Warren Buffett is doing. So, the question I know you have right now is, what do I actually do with this? I want to be crystal clear. This is not investment advice. Talk to a professional. But the single most instructive data point available right now is what Warren Buffett is doing. Warren Buffett. Now, Buffett has lived through more market cycles than almost any investor on earth today. He has seen 1929 era aftermath. He has seen the 1970s grind. He was around for 2000. He navigated 2008. He has seen what happens when a market priced on multiple expansion meets the compression cycle on the other side. And right now, Berkshire Hathaway is holding approximately $370 billion in cash. That is not just a big number. In percentage terms, relative to the overall size of his portfolio, that is the highest cash allocation Buffett has held in his entire career as a public investor. Every cycle he has seen before, every crash, every panic, every buying opportunity that came before this one, and this is where he has more cash than he has ever had. That is not diversification. That is a man who has done the math and decided he would rather earn yield on T-bills than own the S&P 500 at current multiples. Because that is exactly where he is parking it, not in a savings account. Short-term treasury bills, earning a return, staying completely liquid, ready to step in at scale when the reset comes, and assets are priced at valuations that actually make sense against the historical earnings record. Now, I am going to be straight with you. Sitting in cash and T-bills is the first move. It is not the whole playbook. There is a deeper layer of strategy around contrarian positioning, around understanding which asset classes hold their purchasing power through a multiple compression cycle and which ones get obliterated. That is not a conversation that fits in the last few minutes of a video. And it is definitely not a conversation your average financial planner is set up to have with you, because their business depends on you staying fully invested at all times. The dollar cost average and hold playbook, the buy the dip strategy, the time in the market mantra. These are not universal truths. They are rules calibrated for a specific environment. Rising multiples, growing working age population, expanding passive inflows. Every single one of those conditions is now in question. The people who recognized that shift early, who understood that the data does not care what Dave Ramsey told you, those are the people who will be positioned to buy assets at historical trough prices while everyone else is starting over. That is not luck. That is paying attention to what the data actually says rather than what is comfortable to believe. This is not doom. This is a framework. Michael Burry laid it out in 2005 and was dismissed as a lunatic right up until he was spectacularly correct. He laid it out in writing, backed his conviction with real money, and sat through 2 years of people telling him he was wrong. He is laying out a new framework right now. The data behind it is 125 years of documented market history. The mechanism behind it is sitting in plain sight in the demographics and the passive investing flows. The $370 billion Buffett cash pile is pointing in the same direction. The negative 92,000 non-farm payroll print is pointing in the same direction. You do not have to believe the 77% number is certain. Nobody is saying it is certain. What Burry is saying, and what the historical record confirms, is that this is within the documented range of what markets do when the multiple mean reverts after a long expansion cycle. It has happened before, more than once. At the exact scale he is describing, the question is not whether the math works. The math works. The question is not whether it has happened before. It has happened before. The question is whether you are going to look at this information before it matters, make some decisions, get positioned, and be on the right side of it, or whether you are going to stay the course right through it and deal with the consequences on the other side. Thank you for watching the Miller Report. If this breakdown gave you something real to think about, hit subscribe and share this with someone you know who has retirement savings on the line. This is exactly the kind of information the financial establishment would prefer to keep off your radar.